the most profitable protocol on earth are DAOs, but some VC are trying to convince you that DAOs are bad because they want you to sell a token. At the end of the day, we see what works. Bitcoin works, Ethereum works, Maker works, Aave works, and we believe there's still room for innovation.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub rewarding you to protect the multi-chain. So not only can you protect your own data across any asset and any chain, but you also get shielding rewards for strengthening data privacy protections for everyone. So you can check them out at namada.net and follow their mainnet launch. Stick around, you're going to be hearing all about them later in the program.
All right, everyone, welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer, the views expressed by my co-host today are their personal views and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
Hey everyone, welcome back to another episode of Bell Curve. This was an interview that I did with Marc Zeller of ACI and who's been a day one contributor to Aave, the DAO. This was a fascinating discussion. I had a lot of fun talking to Marc. Initially, I wanted to have him on to discuss Umbrella and the Aavenomics update. So it's a set of interrelated proposals that are coming down the pipe, which is actually a really big change to Aave that has big implications for the token, the structure of the protocol in general, investors, which I thought was fascinating. But we actually had a much more broad-reaching conversation around Marc's history and background and how he got involved in crypto, what he thinks about DAO governance, and how he started to get involved with Aave. We get deep into the structural changes that are coming down the pipe in terms of Aave. But then we had a long discussion around the state of the union around DeFi, some of the converging business models that's happening, and then there have been some tweets recently from OG DeFi founders like Kane about sort of minimum viable issuance and some of the Ethereum Foundation posturing towards DeFi, which I thought was a really interesting discussion. And then we concluded with potential expansion into Solana and wrapped Bitcoin. So there's been some drama this last weekend of BitGo selling the majority stake there and some potential security risks around wrapped Bitcoin, which is a big piece of collateral in ETH DeFi today. So this was a really interesting conversation, and I hope you all enjoy it as much as I did. All right, everyone, welcome back to another episode of Bell Curve. Today, I'm joined by the one and only Marc Zeller. Marc, is it Marc Chainsaw Zeller or is it Marc Billy Zeller? It's tough to keep up these days with all nicknames.
You know, inside you, there's two wolves. And for me, there's the nice version, which is the Billy Zeller, focused on making money for the DAO. And the mean version of myself called Chainsaw Zeller, making sure that there's less obstacles in the DAO journey. And sometimes you need both. You need to be nice and you need to be tough. And I'm happy to do both, depending on the situation.
Was Chainsaw, was that inspired by Chainsaw Al Dunlap, or was that a Marc Zeller original?
No, it's inspired by because when we launched the ACI around 2 years ago, the DAO was not as efficient as it is today. Every DAO has some inefficiency, and it's normal because it's a new way to organize things. And decentralized autonomous organization is an uncharted territory, how to organize a protocol and manage it. So the name Chainsaw is a reference to the Argentinian president Milei, and that is quite known for Afuera, where you remove a lot of fat inside the Argentinian government. That doesn't mean I support the guy specifically, but he was known, and it was quite the meme in the Argentinian politics, that he was with a chainsaw saying, we're going to cut the unnecessary expense for the government. And that yielded result for them. And I think we done the same thing, and we cut the expense a lot for the Aave DAO to focus on the efficiency and on the yield of the spending we did on behalf of the DAO. And I believe the return on that investment and this new way to manage things was incredible, because every single metric for the Aave DAO is up for the past 2 years.
So Marc, I brought you on here because I wanted to get your take on this. Some of the big updates that are actually coming through Aave, namely the Umbrella update to the safety module, but also these updated Aavenomics that you're talking about. But maybe before we actually get into that, what is your philosophy in terms of how DAOs should be managed? So I like the idea of a chainsaw. I like the idea of efficiency in general, but it seems like a lot of DAOs have this natural tendency to to leverage committees, which sort of slows things down. And in some bad cases, I think there ends up being this concept of looting the DAO. And you've been super
Yeah.
active in Aave for a really long time. So what's your general philosophy just in terms of DAOs in general? What's best practices in terms of steering and managing them?
This is something that I presented during the HCC, not this year, but the year before. And the main motto of the ACI vision and doctrine for the Aave is minimal viable bureaucracy. And I think it's extremely important to strike the sweet spot between having a framework and having clear rules that are accessible to anybody that wants to participate to the DAO, but to remove the bureaucracy and the gatekeeping as much as possible. That's what we created a lot of products and services with the ACI on behalf of the DAO that are completely open to anybody that requests them. One of them is Skyward. So basically, if you have an idea for the DAO and you don't know how to implement code or you don't know how to do things, you can just talk to the ACI, do a temperature check, which is a very lightweight governance proposal. And if the community agrees with it, we, the ACI, will escalate that on your behalf on snapshots. We will make sure the format is standard with the DAO requirements. We will escalate it to have a request for comment, which is a more formal ways to do a governance proposal that will require the feedback from service provider of the DAO. All the complex stuff, we will do it for anybody and we will do it for free because we do not believe in gatekeeping. And we believe that there's some people with great ideas and some people that can implement those great ideas and follow the intricacy of the governance maze. And that's not always the same people. So we make sure that if you can add value to the DAO, all the bullshit about bureaucracy and code, we will do it for you and you can focus on the value you want to add. And we implemented things like that at every single level of interaction with the protocol to make sure that the DAO stays open, but everything is well managed and streamlined.
Mm. So what do you think about the idea of there being, in any sort of human organization, there needs to be some sort of leader or face? And I would be curious, Mark, maybe I could get a little bit of your background here. I think that many people, kind of think about you as the man, behind the curtain in terms of Aave. And I know Aave is way ahead, of many of the other DAOs operating in crypto in terms of actually decentralizing. But I feel like you've really become a force to be reckoned with, not only in Aave, but in generally in sort of the DeFi scene. And I would just love to get your sort of history and background and how you found yourself in this position at Aave, at ACI, and what it's like, contributing super actively to a DAO the way that you do.
I mean, the first thing I want to say is that my voice is only the voice of more than 300 address now that delegating their trust by their token holdings. So the way the DAO works is that if you have one Aave, you have one token of voting power for the governance. And I currently have like 375,000 Aave votes. I would love to own 375,000 Aave. That's like $30 or $50 million or something like that. Unfortunately, I don't have that much money. I would love to, maybe one day, but not right now. So 100% of my voting power is actually from people inside the community. And when we launched the ACI, I was very strict on where I can source my voting power. I refuse to ask for any voting power from the former Aave company that we call Avara now, because otherwise how can I be independent? I refuse to ask for any voting power from VCs, because how can I be independent, or for any project? So if I get some voting power from Lido, I will be influenced by Lido. So as an example. So 100% of the ACI voting power comes only from community members that are not associated with a fund or with a protocol or with a VC or with a company that operates in the space. So just a bunch of people. Some of them delegate like $100 worth of token to me. Some of them delegate $10 million worth of token to me, because some people are rich and some people are less rich, but all of them can support the ACI in their own way, and every bit of support is appreciated. And so that makes me the largest delegate right now in the Aave DAO. But the second one is big as well, the third one as well. And if you do the math, I'm not big enough to pass a proposal on my own. Otherwise, some proposal I will not have failed some proposal because my track record is not immaculate. I tried a few things and the committee say no, and I think it's a good proof of decentralization. If 100% of my proposal will be yes, it will be like some kind of dictatorship, and I don't think that's a good thing. And the other things that I want to say about this topic is that this is liquid representative democracy. So if tomorrow the community and the people that delegate their voting power to me and the ACI do not believe I am adding value, they only have one transaction to do to remove the voting power to the delegate to me. And in the past, I lost significant voting power from big whales because they were not agreeing with stuff I was doing in the DAO. A good example of that, and the biggest event we had in terms of voting power we lost in the past, is when I supported buying back CRV tokens during the CRV attacks on Aave in November last year. I don't really remember the exact date, but it's pretty easy to find for people doing research. And I was supporting buying CRV token because we were building the Go stablecoin, and I was in my plan was eating two birds with one stone. So acquiring strategic asset for secondary liquidity of Go. So if we acquire CRV token, we can vote for the Go pools and incentivize liquidity that way. And the second stone is that we can support the CRV asset in a time of trouble where Mitch was about to be liquidated. One of the very significant delegator of the ACI was not thinking the same way and was opposed to delegate CRV. So we lost around 30% of our voting power in that day.
Wow.
Because it was like the largest delegate we had back then. So it's not a delegate anymore of the ACI, but we have the trust of other people in the committee. And I think that's how a liquid representative democracy should work, is that people should support you. And if they disagree with you, they should be able at any point to remove their support. And I would not consider Aave as decentralized as it is right now if we are very fixed delegation for everybody involved in the DAO. That means that if tomorrow someone add more value than us to the Aave DAO, or leadership, as you call it, position might be removed. And I think that's a good thing because what matters at the end of the day is the protocol itself.
And for listeners who are following along here, by the way, who aren't maybe as familiar with Curve, which is the stable swap exchange, they have a VE sort of gauge type mechanism where the more Curve that you buy up and stake, you can direct emissions of the protocol into that pool. So it's a really powerful bootstrapping mechanism for stable coins like Go. Just a little bit of extra context for Did you guys end up doing that, Mark, or?
Yes, we did. And the Go stablecoin is extremely stable. And when we got the Black Swan last week, Go stayed at $1. The liquidity is still strong. The GSM, which is the protocol stability module for the Aave system, grew to $9 million, which is good for our liquidity. We lost 15% of the supply due to liquidation, but that did not result in a depeg of the Go stablecoin. So we got our first Black Swan and we resisted. So if I had to do it all again, I will do it exactly the same way, even if I lost some support that day.
Good. And by the way, ACI stands for Aave-Chan Initiative. We'll link in the show notes for folks who want to figure out more details about that program. But Mark, before we get into, because I want to talk about Umbrella now, but before we get there, I do want to get your sort of origin story here. Is like, what initially attracted you to Aave? Like, were you playing around with a bunch of crypto protocols before, experimenting with being a delegate, et cetera? Like, what was it that drew you to Aave specifically?
I'm part of the, so I started in 2015 my crypto journey, and I'm one of the creators of Ethereum France that are the organizer of the ETHCC, which is the largest European conference about the Ethereum ecosystem. I work at Consensus. I did some research on stablecoin in 2016. I work for the first crypto asset service provider called Coinos in France, that the first licensed and regulated exchange to buy and sell crypto in the French territory. And in 2019, I was invited by the Aave companies, so the former name of Avara, that was doing the pivot from Atland, which was a peer-to-peer lending protocol, to what Aave is now, and to prepare for Aave V1 that was released in 2020. So I was the head of integration, developer relation, and head of PD. And we grew Aave to what it is right now. And 2 years ago, the whole idea from day one was to decentralize the protocol. So 2 years ago, I felt it was time to leave the initial company and create my own and participate. And instead of being on the payroll of the centralized company, to start being on the payroll of a decentralized autonomous organization, and that's what we did with the ACI. So it was a new adventure, but 2 years after, we can see very good results for the protocol.
Nice. Well, congratulations on making the hop, sir. All right, I want to dive in here to some of the changes that are being made to the or proposed changes that might be coming down the pipe in terms of Aave soon. Hey everyone, this episode is brought to you by Namada, the shielded asset hub protecting the future of the multi-chain. Namada is a chain that's near and dear to my heart because in previous seasons of Bell Curve, we've talked about how the cardinal original sin of most blockchains is not thinking about privacy from the beginning, but also because if we want to onboard a whole bunch of applications, it doesn't work in a default transparency setting. So Namada not only brings about a better future that we all want, but it's going to help onboard a ton of new applications. So Namada introduces a novel shielding reward system. The way that it works is if you hold your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect non-rewards in return. Namada will initially support IBC and Ethereum-based assets, but eventually the idea is for this to expand into a comprehensive hub for all assets. Really, really excited about what the folks over at Namada are doing. I highly recommend that you go and check them out at namada.net. You can follow their mainnet launch, which is soon TM. Very exciting. Tell them that I sent you. Click the link, bottom of the show notes. Mark, for folks who might be, I'm sure anyone who's listening to this program is going to be familiar with Aave just as a borrow and lend protocol, but can you help take our listeners one layer deeper? And what are some of the major sort of mechanisms or parts of the protocol that people would need to understand in terms of how it works today, which will set up the change in terms of what's coming forward with Umbrella? So maybe just talk a little bit about the role of Aave and staked Aave in the current system, the safety module, and anything else you feel like is required for listeners to understand the change of Umbrella.
There's a lot of things to cover, so I will try to speedrun this to be mindful of the time of the people listening to us. So Aave, you can, if you are like 80% of our user, you provide asset and you get some yield on top of it, and that's it. That's 80% of our user base. They just do that. They provide stablecoin, they provide some ETH or ETH correlated asset, and they get some yield out of that. The yield is not magic. It's not a Ponzi or this kind of weird stuff. The yield comes from exclusively from people borrowing your asset that you provide, you as a LP on the protocol. And in exchange of that, they pay you an interest rate. That interest rate goes back to you as a liquidity provider, minus a fee that we call the reserve factor that goes back to the Aave DAO. That's how it works. In order to borrow asset into Aave, you have to provide other asset as collateral. So if you want stablecoins, most people, they will provide Bitcoin, WBTC, or ETH correlated asset like Lido, STETH, ETH, or Wrap ETH, or Ether5, WETH. And they will do that because they believe the value of ETH will go up in the future, maybe not in the short term, maybe in the long term, maybe they are wrong. That's all about the markets. Sometimes you are right, sometimes you are not. And when you are not, you lose money. So you should do your own research. But if you are right, you can borrow stablecoin and then spend it instead of just sending your ETH. Or you can use the stablecoin that you borrow to buy more ETH. And if the price of ETH is higher in the future, well, you will have more money in your hands and you will need to sell less ETH to repay your debt. That's the cornerstone of DeFi. DeFi is decentralized finance, and Aave is the largest and most liquid and the safest venue to do that on chain. Right now, we have around $21 billion of liquidity across, I think, 7 networks now. It's growing every day, so most likely 7 or 8. And that's it. If the price and the value of collateral drop sharply because there's a black swan event and your position is not collateralized enough to cover your debt, there will be a liquidation event. So anybody can pay back your debt on your behalf. We call this guy the liquidator. They are not running a charity. They do it because they will take part of your collateral as a liquidation bonus. So if you have $100 of debt and $150 of collateral, they will be allowed to take $105, for example, from your collateral, pay back $100 of debt, and keep $5 to themselves. They do that to protect the protocol and make sure that the liquidity providers, the people that have no debt into Aave, have their assets safe. If they fail to do that, we have, and we are the only one at this scale to have a backup plan as a protocol. It's called the safety module. We have around $500 million in Aave assets and Aave liquidity that is taken by anybody that want to participate in it. And that is rewarded by the liquidity, the safety incentive. And in exchange of this incentive, these people that are staking their Aave or providing liquidity in Aave and ETH agree to be a line of defense to protect the user from bad debt. So they will repay debt on behalf of user if the collateral is not enough to do it for the liquidators and the liquidator fail to do their job. We never had in the past the need to use the safety module. But if someday there's a bigger black swan than what we are used to get every other month in crypto, maybe that can be useful. I think that I covered the basics.
I think you got all the I think you got all the big ones there. And one other additional point as well is that in the safety module, to my knowledge, right, we've never actually needed to use that, correct? And the other thing would be that there's a program to incentivize secondary liquidity around Aave, which is relatively expensive. Just in the case that you would ever need to do like a season sell type thing, and use Aave as a backstop to protect the protocol against bad debt. Obviously, Aave, it's in Aave protocol's best interest for there to be a very liquid market for Aave. And so there's an incentive program to incentivize that secondary liquidity. Okay, so I think that's setting basically everything up. And now what I want to do here is could you give us, Marc, just an overview of Umbrella? And I'm gonna share my screen here. And I've actually shouted this out on the protocol before, but this is a great tweet and diagram here from Sonia, one of the chefs over at Steakhouse. But it's a balance sheet view basically of how the Aave's balance sheet changes with the old existing safety module that we just described versus how it's going to look in this new burn and sort of a token safety module. So can you just describe what Umbrella is in general, Marc, and then maybe we can get into some of the nuances around this balance sheet view.
I was not aware of this diagram, and it's very, very good. I think we should add that directly to our forum post. I will send her a message to participate in the governance discussion because it's very clear, and that's better than what I did. So shout out to Sonia for doing this. So what happened right now, it's on the screen, but I will describe it, is if there's some bad debt inside the protocol, we will seize in the safety module some Aave token and send that into the secondary liquidity, which is Stake Aave and Stake BPT token. And out of around $500 million that we have in there, we can extract whatever Aave is worth. Because what is worth $200 million of Aave right now, if there's a black swan event, maybe we can extract 150 million, maybe 100 million, because obviously the DAO will not be the only one sending tokens on secondary liquidity at that point. So there's no way for the DAO to know exactly how much bad debt we can cover with this system. So this system was very simple, and that's why we adopted it on day one, but that was 2020, at the end of 2020, early 2021. And now we are in 2024, and we can do things more optimized. So the whole proposition is the principle of Umbrella is to completely remove this system. So this old safety module becomes the legacy safety module, and it's going to be deprecated if the governance vote for it, and replace it with a new system where user, instead of staking Aave, they can stake directly the A tokens. So A token is the recept asset you get when you deposit liquidity into Aave. So if you deposit USDC, for example, in Aave, you will get a USDC directly back into your wallet. It's an IOU that allows you to withdraw liquidity from the main protocol pool. And if you agree to stake the recept asset, you lose three things. the first thing that you lose is your ability to be liquid. So when you have an A token, you can withdraw anytime from the Aave protocol. If you stake it, you agree to not being able to withdraw for the next 20 days because you will have what we call a cooldown period. The second thing that you forfeit is your ability to borrow. Because if you have AUSDC, you have borrowing power in the protocol. But as I said earlier in the beginning of your discussion, 80% of our users never borrow. They deposit USDC because they want more USDC, and so they don't really care what they about their borrowing power. What they want is their ability to get some yield. The third thing they renounce by doing that is their ability to be protected, because they are being volunteer to protect the other guys. So their asset will be a line of defense to protect the protocol and the other user from that debt. So what happens is, if there's what we call a shortfall event, so the value of collateral drops sharply overnight, and the liquidator are not fast enough to liquidate the position and protect the end users. And when I say we, it's the DAO, and it's fully automated. So there's no human intervention with the umbrella system. We'll seize the AUSDC, the AA rate, wrap it, or whatever asset that is fit to do that in the safety module, and burn the debt with it. So that's a seize and burn, and it does not rely at all on secondary liquidity. So if you have a 1 million AUSDC debt, that means there's 1 million AUSDC holder that cannot withdraw from the main pool, because the liquidity is not enough, because there's bad debt in the protocol, and you cannot liquidate the position to make sure there's one USDC that you can withdraw for every single AUSDC. So what you do is that you take the AUSDC you have in the safety module, because people agreed in exchange of a yield to be the first line of defense, and burn that debt to make sure that them cannot withdraw from the safety module. So they actually lose money, but that's what they do. It's a safety module. They sign for it in order for the other LP to be able to withdraw from the protocol. And this system doesn't require any swaps or any kind of special liquidity. So if you have 10 million AUSDC in the safety module and 1 million debt, you do a 10% haircut to every AUSDC stakers, and that's it. I hope it's clear, because it's a bit complex as a system.
Okay, no, it was a really great explanation. I'm going to see if I could repeat it back to you and just correct me where I'm wrong. So in the legacy model here, and I'm going to actually walk through this version of the balance sheet. So if you're following along on video, again, in the assets, there are crypto-backed loans. There are the A tokens, which is the sort of synthetic interest-bearing representation of your claim in that pool. And then there's a surplus, which is a mix of the treasury and this sort of backstop that staked Aave and the also the secondary liquidity incentive actually provides. So in the instance that there was bad debt, again, in this legacy model, what would happen is the protocol would actually seize and sell some of that Aave out into the market. And so the downfalls of that is that, one, you're actually not matching your assets and your liabilities, because you're selling Aave for something that might something like ETH or something like that. So there's actually kind of like Forex risk there. But there's also this like slippage and the ability for there to cause this kind of downward spiral in terms of the actual Aave price. And there's the cost of incentivizing that secondary liquidity. So all in all, it was a really good first attempt, and it was very simple. But the improvement here that you've outlined is, again, let's go down and look at the second part of the diagram, which is same thing in the assets. There are crypto-backed loans, there are A tokens, and then there's a subset of users, holders of these A tokens, that are opting into staking them. And there are some of the drawbacks that you mentioned. There's a cooldown period, things like that. And they're opting into taking this extra risk in the case of covering a bad debt. But you're also getting some incentives, which we can talk about in a little bit. So in the case of bad debt here, the nice thing about this is that you've actually matched your assets and your liabilities, because the staked A tokens is going to be denominated in the same asset. So like if this was a wrapped ETH pool, it's just much easier. And then instead of actually going out and selling some Aave to try to pay back whatever the bad debt is denominated in, you can actually just burn a small subset of the staked A tokens, right? So you can just seize it and burn it. There's no slippage. It's a really elegant mechanism. Did I roughly get that right?
That's perfectly it. So why would people take all that risk? And
Right.
the answer is extra yield. And when does the yield come from? Well, there's no magic. So every single liability, every single crypto-backed loan pays interest, and it pays interest in what we call the reserve factor. This reserve factor is 5 to 15% to depending on the asset you borrow. So if you borrow, for example, ETH or WST ETH, you will pay less than if you borrow a stablecoin that is a bit less mature than the main stablecoin like USDC or USDT. And part of this reserve factor, we can use the excess revenue from the protocol as a cashback to a subset of the liquidity provider. So they will get the interest paid by the borrower plus a cashback of part of the protocol fees that goes directly to them. And because these people are a subset of all the users, even a small cashback is a big increase in terms of their yields. So if you take the numbers, there's, for example, more than $1 billion of borrowing volume of USDC on Aave mainnet. And if you have 100 million USDC, so 10% of the LPs of USDC that opt in to be on the safety module, and you want to give them 3% extra yield per year, that will cost you around $3 million. But you have the $1 billion paying fee to you. So the actual cost for the protocol compared to the revenue or overall is something that is manageable. And we did the math on this. It will be discussed in the next stage of governance. But with the current revenue and the profit of the Aave DAO and the protocol, we are confident we can achieve billions of dollars of user protection with a very limited cost to what costs the current system. So it's very efficient in terms of new system.
Yeah, it seems like a really elegant mechanism. And before we get into some of the actual buy and distribute parts of the Aavenomics update, which is builds on this but isn't directly related to it, what can we take away in terms? Like, there are a couple of takeaways for me here, which is one, it seems like there's an immediate cost savings from the protocol to not needing to incentivize all of that secondary liquidity for Aave, right? So I'm just curious, am I correct on that? And if so, what's the quantum, that we're saving here? The other thing from a token perspective, again, not financial advice, nothing like that, but I think one of the challenges around Aave as an investment from my standpoint was always, hey, this is, we've never had to use this and it's a black swan type event, but ultimately you have to, as an investor, probably apply some sort of haircut or discount to Aave because it acts as this like last reserve, in the case of bad debt for the protocol. Now, I think what you've essentially done for Aave, the token, is you've removed that risk. So it would make sense for me to re-rate up a little bit if we're all, putting on our fundamental investor cap. Do you agree with the cost savings and kind of removing this risk from Aave, the token? And is there anything else that I'm missing here in terms of the implications?
So there's three things. The first thing is that how can we afford to have fees where the competition has much less fees or even no fee at all? I think it comes to the fact that Aave users are ready to pay to use Aave. When you compare that with other actors in our vertical in the industry, the other actors pay the user to use their protocol. And I think we are the only one in the current situation where we are here since long enough and we prove the seriousness and the fact that when you use Aave, there's a very little chance that you lose all your money. But there's always a chance because there's always risk. And I'm not saying Aave is without risk, but I have the feeling, and it's proven by data, that people are ready to pay to use Aave and they are okay with the fees. And because the fee created a self-sustainable economy of the protocol can pay all his own bills. So he can pay for the bug bounty, he can pay for the development of the new version of the protocol, Aave-v4, he can pay for the ACI operating budget and all the service provider budget, and there's more. And that's the main thing, is that we are one of the only DAO on Earth with MakerDAO, which is one of the notable exceptions that are cash flow positive in terms of a protocol. So what can we do with this money? And the first thing is we can create systems that are more efficient to reduce our cost, but increase the safety of the user. And that's the paradigm shift of Umbrella, because we believe that for a fraction of the current cost, that is token incentive to stake Aave holders, we can have increased efficiency of user protection by orders of magnitude. And that's the very important part and the paradigm shift of this update. The second thing is that what do we do with the extra money that is left after that? Do we grow the treasury? Like the Aave treasury in stablecoins and ETH correlated asset is around $60 million as we are speaking, and it grows to of $100 million per year, something like that. So do we just sit back and wait until we have $1 billion in the treasury? I don't think that's very interesting. Or do we start to implement new things and use the money to grow more, or to create another economy for the main asset and the governance asset of the protocol? So that's the path. We took the two paths. So we created the merit program, which is a $20 million per year to incentivize ETH liquidity, which is the most strategic asset. So wrap ETH is the most strategic asset in lending, because each wrap ETH that you attract in your protocol, you will bring 1.3 to 1.5 ETH correlated asset, LST or LRT asset, that will use that liquidity to do leverage taking. So if you want to grow and grow your revenue, spending money to bring more wrap ETH inside your protocol is money well spent. And that's what we are doing with the Lido market. And we grew to $300 million in 3 days. That's the biggest and fastest growth that we had in the whole Aave history, because institutions were very keen to have only ETH correlated asset as a counterparty in this specific market, and also to have incentive of providing wrap ETH liquidity. So it's a self-sustainable market. And the second thing was spend money to grow the Go stablecoin, because the Go stablecoin is a very specific asset in the Aave ecosystem, because there's no LP. The protocol itself is the LP, just like DAI in the MakerDAO ecosystem. So instead of sharing 95% to 80% of the revenue of the interest paid by the borrowers, you keep as the DAO 100% of the interest paid by the borrowers. So spending money that you get from all the stablecoin usage inside the Aave ecosystem to grow the Go stablecoin is money well spent, because one Go that is minted is the equivalent for the Aave DAO in terms of revenue to 6 USDC that is borrowed into Aave. In terms of, sometimes it's a bit more, sometimes it's a bit less, but that's the kind of stuff. So we use the money, the excess revenue that way. But what do we do with the money that is left? Because even when you do all that, there's still $40 to $60 million of extra revenue per year. And the idea was to create a new system that will implement buy and distribute. So you use the extra revenue to acquire assets in the secondary market, which is the Aave asset, and you distribute that to the holder of stake Aave that are part of the legacy safety module that will become the staking module.
Mm. Okay, Marc, there's a ton there, and I've got a lot of questions for you. And before we get into some of the specific choices that Aave's made, I want to get this is one of the oldest debates in all of Blockworks, actually, which is, should protocols redistribute revenue to token holders? And if so, what do you ask them to opt into some additional amount of work or something like that? And, even like a separate subset of that is, what's the correct mechanism, right? I want to ask you about why buy and distribute as opposed to buy and burn or something like that. But, here, maybe to just set up both sides of this debate. And I sort of heard you say you're doing a little bit of both. There's a huge amount of reinvestment in growth, but there's also some amount of returning fees to users in a form of dividend here. But if I had to set up the two arguments in terms of this camp, it would be, look, if we were talking about a early stage company here, like someone that just raised their Series B, returning funds to shareholders would be crazy. It'd be like, hey, you got to reinvest that in future growth, right? So that you can try to get market share or optimize your growth metrics or whatever it is. Just much too early in the life cycle of the company to be returning funds. On the other hand, I think if I had to steelman the argument for returning funds to token holders, is that one, this is actually another shout out. Sonia, I took this from her as well. Shout out to the whole chefs, by the way, who do a really great job of this like balance sheet view of protocols. They do really great work. But tokens might be a little bit more of a low trust environment than stocks, right? The rules of the road and the laws around early stage equity in the US especially are really well written. And investors, you don't need to see a lot of proof, because there's this long precedent of companies, software companies raising a ton of money and then eventually returning that money to shareholders. Be that, you could point to Apple or Facebook or whoever it is. Even the ones that burned a ton of money at the beginning of the day, raise the money at the end of the day. There are all these legal protections for investors. So I don't really need to prove to you that I'm going to return fees to shareholders in the early days. But maybe tokens, there are no real examples, right, of that. And so actually
Yes.
investors might logically demand a little bit more proof that I want to return some of these funds. The other thing is, protocols like Aave, and I'm gonna bring the stats up here in a second. Actually, I'll just bring them up right now. They do a better job of earning revenue earlier in the life cycle than a lot of other companies, right? And so, but I guess the downside is once you start to offer this kind of value return mechanism, like something like a dividend, that ends up being kind of a weight around your neck, and it's very difficult to ever stop doing that in the case that you needed to. So, Mark, give us your high level philosophy here. Help us think through, how should we think about this generally in the lens of crypto, and then maybe translate that into some of the decisions that you've made at Aave, or Aave has made as a protocol.
So I will try to speed run my answer as well, because there's a lot of things to say on this topic. The first thing is that you need to be mature enough. If you don't have significant and since quite a lot of time excess revenue in your protocol, it doesn't make sense to burn money just to buy back asset and burn them, or distribute that back to token holders. You are in a better position if you reinvest every single dollar that you make, if you make any dollar, because many protocol in our vertical doesn't have any kind of revenue. Like the Uniswap protocol doesn't make a single dollar even today. Uniswap Labs makes a shitload of money, but Uniswap DAO doesn't make any money. Morpho, for example, in the lending vertical, they don't make a single dollar of revenue. Only MakerDAO, DYDX, Curve, and Aave are making significant revenue in our industry right now. All the other ones is insignificant or zero right now. So the first thing is you need to reach a level of maturity where it makes sense to not reinvest everything that you make back into growth. The second thing is that you need to be decentralized enough. If your governance is just like VC puppet governance theaters, it doesn't make sense, because at the end of the day, you are operating a company. And I do believe that there's a huge difference between decentralized autonomous organization and just companies, because in terms of management and who actually controls the protocols, it's quite different. And the third thing is that you need to make something that is scalable and sustainable for the long term. And that's why in the Aavenomics proposal, I set and I propose some milestone of specific goals of revenue, specific size of the Go stable coins that will allow the Aave DAO to not stop the incentives or the redistribution or the buy of and distribute program overnight, because the market conditions are less good than before. Because I think that when you start doing this, as you say, if you stop it overnight, you should stop it because there's clear rules and indication
Right.
that that's the reason why you should stop it, because you reach the market metrics that means that you should stop doing that and refocus your resource to something that is more adding value to the protocol. But I think the best scenario is that you never stop. You can reduce if things go bad, but you never actually stop, because otherwise the community will be used to get something, and if they get nothing overnight, that's not that is the best scenario for them. But the most important part for me is that you need your protocol to be decentralized enough.
Yeah. And Mark, question for you on just the mechanism that you use to return that value to token holders. So it looks like Aave has proposed a buy and distribute here. I'd say one of the other really popular ones is a buy and burn type mechanism. And maybe there's some analogy here again to use, trad corporate speak. This is something equivalent to a dividend, or something equivalent to like a share buyback, which effectively does the same thing, but there's a difference in terms of tax implications. So why was there a buy and distribute mechanism here as opposed to buy and burn or something else?
It's actually an interesting debate. And what I want to say is that we are a DAO, so nothing in the proposal is set in stone. It will be set in stone after the last vote. So the actual implementation of how things will be done is still open to discussion. What was approved right now is the temperature check. So the committee and the voters said, well, we think it's important to have this debate. So let's start working on this, and let's start implement step by step the whole plan. That's the way things work right now. The buy and burn method was actually the first tokenomics of the Headland ecosystem, so the ancestor of Aave. So the small revenue we had back in 2019, 2018 of the Headland platform was used to buy on the secondary market land asset and burn them and reduce the supply. We do not believe it's an efficient way to do things, because at the end of the day, I'm very attached personally. Maybe that's my doctrine and only my vision to do things, and maybe the community would not think the same way. But my vision is that you the buy and distribute has the elegance that it takes Aave from people leaving the ecosystem and give it back into the hands of people that are long-term aligned and are ready to stake and renounce their immediate liquidity with the asset for a period of time. Because even in the staking module, you will have a cooldown period. So you will have to stake for an amount of time in order to get rewards. So it's all about how do you create an economy and self-sustainable economy that align the most wanted behavior from your community. And we believe at the ACI that the buy and distribute makes better alignment than the buy and burn.
One other thing that at least I've noticed, or I've had a theory on, sort of a pet theory on this for a little while, is that, again, traditional markets are much more efficient. And so when there's an announcement of a public company based out of the US or anywhere really, that they're issuing new stock, in a very efficient way, the price of the current, the share price tends to price that in like almost immediately, right? The more shares that are issued, the more the current price goes down because the market cap doesn't change. I'm not really convinced that crypto is that efficient. I don't think you have a bunch of people or algorithms that are watching and making fundamental decisions like that. So I think there's at least a pretty decent possibility that a lot of these burns that happen in buy and burn mechanisms don't actually transmit value in the way that we think that they might. In theory, over a long enough period of time, supply and demand should take care of that. But I have doubts.
The best example of that is the MakerDAO ecosystem, because that's the largest scale DAO that implement this model in the world ecosystem. And they had a year 2022 and the early 2023 that was atrocious in terms of price action for the asset, while at the exact same time having one of the best economy, on-chain economy that you can find. And they were making shitload of money, shitload of fees, burning a shitload of maker token from their supply, and the price action was a straight line down. Sometimes is unrelated, and I don't really like to comment the price action of tokens, because the market can be irrational, and I don't think what I want to do and my contribution to the Aave ecosystem is to build and contribute to build the best possible product and to make the DAO as profitable as possible. Not a fortune teller. I don't know if that will have any effect on the asset of the Aave token, and I don't think anybody can predict if what we do have actual consequence.
Marc, I want to zoom out here of Aave for a second and get your take on the state of DeFi today. And I was listening to Empire, a good game, and they were describing, I think it was Santiago who's describing a conversation they had with Kane Warwick, who's another sort of OG DeFi founder at Synthetics, and describing that DeFi's been in a bear market for a relatively long period of time, despite some of the metrics that are chugging along. Like, if you actually had it up here a second ago, but if you look at some of the revenue and fee metrics around like Aave, for example, it actually is looking really good, right? Maybe not back to the highs in terms of activity and TVL around 2021, but there's a clear uptrend here, right, in 2023 through 2024. And I would just be curious to get your sense of the state of the market, of DeFi in general. And to your point, there are DeFi and like the Aaves and the makers of the world are some of the only examples that you can point to in crypto. They're actually cash flow generating protocols. And so, I know we don't need to comment specifically on token price or anything like that, but what is needed for investors to appreciate that from your standpoint?
Well, I will not make a lot of friends by my answer, but the older I get in this ecosystem, that will be a decade next year. The more I agree with one fact is that usually you have a good idea at the beginning, and then you have a bunch of VC that wants to make a quick profit by creating shitcoins. So they invest in a bunch of shit to try to create some kind of innovation. But at the end of the day, it doesn't work because the market doesn't want that. So you had a lot of layer ones. Now you have a lot of layer twos. Now you have a lot of layer twos on top of Bitcoin. Then you have DeFi 1.0 with Maker, Aave, Compound, the synthetics, all these kind of guys. Then you got DeFi 2.0. I don't know if you remember that, but
Sure do.
not a lot of this shit survive now because 3.3 was a stupid idea. And now you have DeFi 3.0 because for some reason DAOs are bad and protocols are not efficient. So the most profitable protocol on earth are DAOs, but some VC are trying to convince you that DAOs are bad because they want you to sell a token. At the end of the day, we see what works. Bitcoin works, Ethereum works, Maker works, Aave works, and we believe there's still room for innovation. And when you look at Maker, it evolves a lot around the years. We are at Aave version 3. We are working with the Go stablecoin. We are creating new markets, new way to do things. We did not stop working. Ethereum continue to work. Sometimes you have a new guy that joined the party and it's an actual 0 to 1 innovation, just like Solana was for specific use case. So he joined the club with Ethereum, just like Aave was an innovation compared to Compound because we created the flash loan, the stable rate, a new way to do things. Maybe there's going to be a new guys in our vertical, but I have the deep belief that 99% of what is proposed and what is shield around social media is not very interesting right now.
So I think this point about maybe creating more tokens, I definitely agree with that sentiment in some senses. I also think that, the more tokens that you create, you end up there's kind of a free market competition that ends up happening. And even though we have to wait a little bit of time, maybe the best business models end up winning out at the end of the day. And I would be curious, Mark, to get your perspective on how you see business models evolving and changing within kind of the old guard of decentralized finance. And I remember talking about this like a year or so ago, where kind of saw this convergence in business models in between like Maker, Aave, and Curve, kind of, right? Like there's kind of different pieces of the puzzle that seems very attractive in crypto, which is kind of like the stable coin, lending sort of mix. And, Aave, which started out as a lending protocol, is now has Go, their stable coin. And on the Curve front, they had Llama, which is their own sort of backend lending model. And they also have, they launched their own stable coin. And even when I look today at kind of the business models in between something like Maker and Aave, like, one's ostensibly a stable coin. There's a lot of like lending on the back end that needs to happen. And it looks very similar in terms of the business model. So I would just be curious, do you agree that there's kind of a convergence around business model? And then, how do you look at someone like Maker? Are they, competition? Are they friendly? Is there a little bit of co-opetition in between those groups? So yeah, what do you think about that whole idea?
So it's very interesting because our relationship with Maker evolves over time. So we were extremely friendly, and I think no one helped more MakerDAO than Aave did. Because we did like liquidity mining or with all the other guys, and we were one of the first one to list DAI into Aave. People don't remember that, but Compound was very focused on USDC in the early days, and Aave was
Same with
actually
Steve, right?
yeah,
Same with
exactly,
Steve.
yeah.
That was a big part of the success of Lido also.
Yeah. So we help MakerDAO a lot. We distributed dozens of millions of dollars of Aave worth of liquidity mining to DAI suppliers into Aave and DAI borrowers across several markets. When we had liquidity mining synergy with Polygon, with Avalanche, with the other guys, we incentivize the DAI stablecoins. So we allowed MakerDAO to make probably hundreds of millions of dollars of revenue. And at some point, due to some internal politics within the MakerDAO ecosystem, our diplomacy went bad. and they decide to be closer to other actors because they believe some stuff that were not factually true. But we actually had a pretty interesting discussion during the HCC, and that's why it's good to have conference and to see people
Yeah.
at face to face and actually discuss things. And I believe we are entering a new era with the Aave and MakerDAO relationship, where there's going to be more and more convergence and synergy between our ecosystem. Because at the end of the day, we prove on the Aave side that we are the kings of the lending side of things. Uh, People trust the Aave code base and the Aave DAO management of reserve to keep themselves safe and make the things efficient. And we are the king of growth. No one managed to survive against Aave on the layer 2 we deploy to. We deploy on a lot of layer 2. Sometimes they are their own native ecosystem, and the scenario that happened on every single one of these layer twos is that Aave took the throne of the leadership on this. And that even happened on Gnosis, which is the DAI chain. So even there, we were number one. And we discuss about that because they are the king of decentralized stablecoins and they have a lot of value add as well in this ecosystem. So there's going to be new markets of Aave. And I at the ACI, we believe and we have strong belief that there's going to be more synergy between the Spark ecosystem, the Maker ecosystem, the Aave ecosystem, and the ACI ecosystem that will work together to create new enhance DeFi products for the protocol. So there's actually we are on the path right now to more and more convergence between the Maker and the Aave ecosystem. So that's quite an interesting thing to do.
Yeah. What do you think? You mentioned L2s there in general, and I actually want to, where I probably want to end this conversation is focusing a little bit on Ethereum and some of the comments that I've been hearing from. I saw you retweeted, but like Kane had this, pretty outspoken post about how folks in the Ethereum ecosystem think about like the DeFi protocols that kind of made, I think, in a lot of ways, Ethereum what it is today. But before we get there, I want to get your thought in general on what you think about, like, what's the Aave strategy in terms of deploying to rollups, and generally what do you think about the rollup centric roadmap? Because from an app perspective, I would imagine on the back end and from an operational standpoint, it was a lot easier when all the liquidity existed on one layer, which was ETH main chain. And now you have all of these different, instantiations of chains they need to deploy to, like Base or Optimism main chain or Arbitrum or wherever. And so I would imagine there's probably some growth opportunity there, but maybe it feels a little bit more fragmented. You have to, maybe you're concerned about counterparty risk or some of the safety and security assumptions to some of these L2s, and also just it seems like more overhead as well. So in general, from your seat in Aave as kind of an app, I mean, what are your thoughts in general in terms of how do you strategize where you're deploying to, and then what are your thoughts in general on the rollup centric roadmap for Ethereum?
There's several things. Firstly, I strongly believe we don't need 50 L2s. The
Yeah.
actual on-chain activity does not justify 50 L2s, and I think 99% of them will die in the next 5 years. Not really die because it's very hard to kill a chain, but will have significant reduction in their revenue, the value of their native asset, and this kind of stuff. Because 99% of them are cash grab done by VCs, and I have in my inbox there. So this was done for the past 2 years, but currently my DMs on social media are people that are trying to get me as an angel for their Bitcoin layer 2. So it's just a cycle. We are an industry that produces assets, and having an infrastructure asset is often the opportunity to have low float, high FTV, and make founder rich. So they try to create new tokens, but it's very hard me to find an actual added value on most of these projects. And sometimes the added value is experimental in terms of technical aspect and implementation and architecture. So you have all the ZK vertical, you have EVM equivalence, but equivalence doesn't mean it's exactly the same thing. And you have trust assumption, security assumption, and also decentralization assumption. I think the Ethereum ecosystem made the mistake or try to gaslight the community to tell people that 50 very centralized layer 2 equal decentralization. And that was the same bullshit with the Cosmos ecosystem, where you have 1 million very centralized chain and you call that decentralization. And I do not believe it's actually decentralized. I believe Cardano is more decentralized than most of the layer 2 we have right now. And I'm not a big fan of Cardano, so that tells a lot of my belief of layer 2s right now. But it's a movement, and I'm very happy to be able to do transaction on layer 1s because the fee were reduced thanks to EIP 4844 and these kind of things. I think the ecosystem will reach maturity in this area, and we will have a consolidation of layer 2s, and we will end up with a dozen $1 billion more ones, and all the other ones will die. Because when you look at the data on the Aave ecosystem, we have the Arbitrum layer 2 that is growing. We have Polygon and Avalanche because they are historical. So they still have a lot of user and growth because they have the trust of being historical chain. We have Base, where there's a lot of activity and it's a fast-growing network. We have Scroll, because there's an ongoing liquidity mining program and a lot of user in that sense. But the other guys are not growing that much. And for Aave to deploy a new infrastructure, to monitor a new secondary liquidity source, to maintain the price feed with Chainlink, and to maintain the risk assessment of all these assets, if the whole market is $150 million, it's not worth it. It's not worth the risk. It's not worth the effort, and it's not worth the investment in terms of service provider that work into it, because the actual revenue is not that interesting. The way we make money on the lending vertical is that we don't make much money per volume, in the sense that the Aave protocol only makes money on the borrow volume, and on the borrow volume, the Aave protocol gets 5 to 15% on the interest paid. So you get 5 to 15% on 6% that you will pay on USDC, that is maybe 30 to 50% of your TVL. So you end up with figures like, for example, on Base, we make $200,000, which is good for the Aave DAO. It's a tiny fraction of what we make on Aave mainnet. Aave mainnet, we make like almost 1 million a week, but it's still a good amount of money. On smaller protocol, we make maybe half of that or a quarter of that, and it's not really worth the money. So that's why we used to be very lenient with the Aave DAO 2 years ago or 1 year ago, and now with the ACI, I'm much more strict in my as a delegate to assess the new network deployment, and we are asking for significant alignment with these new networks to make sure it's a mutual success with both the Aave ecosystem and this network ecosystem.
And so, Marc, do you have an opinion on? I feel like there's a little bit of a schism that's forming here in terms of maybe some people that are questioning the wisdom of the Rollup centric roadmap in general, or just saying, hey, maybe we're already moving down this path, and we're not going to reset the Rollup centric roadmap, but maybe it actually makes sense to improve ETH main chain to the point where if Aave wanted to keep the majority of its business there, it would make sense, right? And so there are all these discussions that are happening right now around multiple concurrent proposers and reducing the Ethereum block time and stuff like that. Do you agree with, would you be in that camp of improving ETH main chain, or are you on board, or is the idea that, okay, it's not going to be 50 L2s, but maybe it's 3 frameworks that we end up with, and most of the activity is going to move up there, and that's the eventuality that we're preparing for? Like, which of those two camps do you fall in?
I believe the liquidity will stay on layer 1, because when you have $10 million, you don't fucking care about paying $20 transaction fee to borrow $5 million in Aave, and you will never care about that, and that's a fact. And but we want to be inclusive with people that have less than $10 million, and that's also part of the ethos of decentralized finance. But you can do that on Base right now, and you can play around with $100 on Base and buy a shitcoin, do deposit some USDC on Aave, get a 6% yield, and be very happy with it. So you don't need 150 layer 2 to allow people to do that. And you can do even layer 3. They do that on the Optimism ecosystem, or even Polygon wants to do that, Base wants to do that, to have app-specific chains on top of layer 2s. And why not? It can work to have these kind of things. It's important to maintain both, but I think the Ethereum Foundation has been overly conservative, and at the same time, they want to change everything overnight. And it's very painful when you are building and you are one of the significant builder on top of a network that you don't have a clear vision of what's going to happen next. I will give a clear example of that. Around 25 to 40%, depending on the period of the Aave revenue, is leverage taking. So people provide some ETH correlated assets, be EtherFi WE or Lido WST ETH, and we borrow some ETH and do some leverage loop on top of that because their position is data neutral. They will not get liquidity if the Ether price goes down, but they will increase the yield they will get compared to just taking, to just holding Lido. It's really important to have predictability of what's going to be the yield on Ethereum to do this thing at scale. Because if you have to deleverage position worth billions overnight, that will create problem with secondary liquidity. You will have the peg of LST, and you will have a withdrawal queue because you cannot withdraw overnight a validator on the Ethereum staking blockchain. You have to. There's a specific amount of slot per epoch that you can do that. And there's been discussion right now happening about the economies of staking of Ethereum, and they want if too much ETH is staked, that the revenue goes down and even goes to negative territory. If this kind of discussion pass and gets included into Ethereum improvement proposal, that will kill this significant amount of the industry and the DeFi industry overnight. And to my knowledge, Aave is not involved at all in this kind of discussion. Compound is not involved at all in this kind of discussion. I don't even know if Lido is invited in this kind of discussion. And we are talking about maybe $10 billion right now on chain. We are talking maybe 10%, 20%, 25% of the whole DeFi industry. And they do this kind of shit overnight, and we just have to bear with it. And there's a big problem with the Ethereum Foundation right now is that I have the feeling, as an actor that are contributing to this ecosystem since almost a decade now, that there's contempt to what we are building. Each time they have the occasion to speak publicly about the ecosystem, what they say is basically, don't do DeFi, do something else. Don't try to use the blockchain for non-financial things. But the thing is that DeFi is what is filling the blocks right now on the blockchain and make sure the staker makes money validating and securing the blockchain. DeFi is the main use case, the main on-chain use case of the smart contract chains, be it Ethereum or non-EVM chain. So it's a bit weird to be in this situation right now.
Okay, so there's a couple of different things there. And I want to respond to, so this was a tweet that got sent out from, and I want to touch on the MVI point. I think is super interesting. So I want to almost end on that point because I think it's such a fascinating topic to dig into and the implication it has for apps on Ethereum. But here's a tweet from Kane, who's the founder of Synthetics. If the only thing propping up your chain for the last 5 years is DeFi, and the best you can muster is begrudgingly tolerating it, you are anti-DeFi. I'm sorry, but the default position should be absolutely falling over yourself to support and encourage it. And I dug into the responses a little bit here, and it seems like he was responding to, and again, don't want to take shots at the big guy here, but something that he had seen in Vitalik's presentation. So this is a response from Lido.eth. I would, of course, I wouldn't change anything. I just think there's never been in Vitalik's persona to endorse projects at the application level, or at the application layer, rather. And Kane said, sorry, I've literally been in the audience for multiple talks where he explicitly said something to the effect of, please do less DeFi. And so, part of that is, I'm sure there's the Ethereum Foundation and Ethereum generally is really, it's always been a North Star for them to be credibly neutral, right? And so what you don't want to do is act like you're favoring a specific ecosystem or something like that, because then another sector might be less likely to build there if it's like, oh, this is DeFi chain. On the other hand, the vast majority of activity is related to if not 100% of the activity on Ethereum today is related to DeFi. And so it does feel a little silly not to prioritize that or to sort of upset that community. And so obviously this is just one guy's perspective in Kane, but Mark, I saw you retweet this and I saw you tweet something similar. So, from your seat at Aave, have you had similar experiences, or, is there validity to this claim that, some of the apps, or specifically the DeFi apps, aren't listened to, or just say more about this in general?
I will say that from my perspective, and maybe I'm out of touch, and maybe that exists, but I'm quite involved in this ecosystem, and I talk with the other DeFi actors, and so far I'm not involved of this existing. Is that we have the feeling that DEF is in some kind of ivory tower, like I have 0 point of contact right now with the Ethereum Foundation, which tells a lot we about the decentralization of the Ethereum ecosystem. Because if you listen to some crazy Bitcoin maximalist, Vitalik is in my DM every day to say, "Oh, can you list that? Or can you change that on Aave? Or please,
Yeah.
guys, stop trading like the old memes." So this is not true. It's actually the complete opposite. I have not talked to Vitalik for the past 6 years. I think last time was during HCC a long time ago, where he was a bit more involved with the community, which is fine. I don't care myself because I don't think Vitalik has such an influence right now within the EF ecosystem. But I would love to talk with people designing the staking curve and this kind of stuff, because when you build something, having predictability and vision of what's going to happen next is extremely important. We do not ask for special treatment. We ask for the ability to be informed and to uh, have the ability to give our opinion as significant actor of the ecosystem. And I'm not asking that for Aave. I'm asking that also for Compound, for Morpho, for Spark, for Maker, and all the other guys, because I believe our vision and our experience and the data we have from stuff that are actually happening on chain with real people money may add value to this kind of debates.
Mm-hmm. Yeah, and I think the completely understand your perspective there, Mark. And I guess maybe to offer, because we don't have a representative from the Ethereum Foundation here to defend them a little bit, right? It's a tough job, right? They're the stewards of an enormous ecosystem. They're really concerned with being, again, credibly neutral, and probably is a testament to just how decentralized it is. There's just like there is in politics, right? There's always a balance between these things, and you probably want to try to find a way to thread the needle in between. If we're talking about the president of the United States, the president of the United States needs to be aware of who their constituents are and do things to help them. On the other hand, you wouldn't want them to be like captive to certain powerful interest groups. And that's just, I think, that the fine line that a foundation has to walk, right? But maybe to get into a concrete example of this, where this isn't just like theoretical, is the minimum viable issuance debate. And there's a great podcast, the great podcast on Uncommon Core, where Hasu and John spoke with Kaspar and Angsgar. We're actually going to be doing a debate live about this at Permissionless with Kaspar and Angsgar and also some of the folks from both Cyberfund and Steakhouse. So that's going to be a ton of fun. We'll do that actually live. But I think just to summarize here, there are basically two different proposals out. Ethereum issuance today levels off like this, right? So the more validators that you have in the network, it sort of tails off in terms of the actual block reward emissions. And then so there's a debate around cutting off or reducing the emissions at the end of that. And then there's a separate proposal, which is actually capping the amount of validators that the Ethereum network can have. And there's a really complex topic, very rich debate. But the implications there are actually implications for the application ecosystem. And there are a bunch of protocols. Aave is a great example. Athena is a great example. Lido is a great example, that are actually built businesses around the assumption of some amount of underlying ETH issuance. And so, Mark, can you just say a little bit more about how this issuance debate could either positively or negatively impact Aave? And in your mind, how should governance and around these sorts of changes, where there are big, broad applications implications for apps, like how should that work from a governance perspective?
So just to explain what can be the implication is that right now, the more validator you get, the ETH that is issue increase, but increase non-linearly. So you don't get like a crazy inflation if you have like 100 million ETH that are staked. So the revenue you get per validator decrease over time. It never goes to zero, but it decreases over time. And we are completely fine with this because markets are somewhat efficient. And if people do leverage loop, that has the effect to increase the amount of validators securing the Ethereum network, but as long as it's profitable. And if the borrowing cost of it is superior of the staking yield of WST, people will stop looping and they will slowly deleverage their position to find equilibrium. And if the staking yield is barely above zero, they will just stop, gracefully exit this kind of position. And we are completely fine with this because that's the free market and that's how it should work. And we do not believe in the future where every single ETH is stake, because at some point you need to use ETH to do all those things.
Right.
But part of the debate, and maybe it changed, but part of the debate was to provide a hard cap of the amount of validators. And if you have more people willing to stake, you can end up in negative yield territory. So you actually lose money to stake, to incite you to get inside the exit queue and to stop validating, because there's two visions, to my understanding. Maybe I'm wrong on this. The first thing is they did not envision in the early days the rise of liquid staking token and liquid restaking token. So they are a bit afraid of the Lido and alike weight within the staking ecosystem, and they don't want 50%, 60%, 80% of the supply stake for any kind of reason. They don't want type. And the second thing is they want to have control on the inflation, because even if the inflation doesn't grow in terms exponentially, it does grow. So you need to have a huge amount of gas usage to compensate with EAP 1559, which is burning the part of the fees of the transaction fee, to have what they call the ultra sound money, a meme where you have an actually negative insurance. And some people within the Ethereum community are very attached to that. So they want to limit the amount of validators to make it easier to get into negative inflation territory. Every side has things that they can support, and we can listen to every side. My vision and the vision of the Aave governance is that some paths and some journey will have significant negative implication in the DeFi ecosystem at large. We believe that ETH is money, but also ETH correlated asset is money. We believe, and I personally believe, that a LST or LRT is a superior form of collateral than just ETH. But I assume it's not the same risk, because I want yield correlated asset to use as collateral to back my debt. And that's something the community wants to use. And that's why LST and LRT grew a lot within the Aave and DeFi ecosystem. And if we destroy part of the industry, it can have consequence also on the usage of the blockchain and the transaction fee that are paid on the blockchain. So some solution does more harm than good.
So, Mark, it's a very complicated debate, and I agree. I think a lot of this is about liquid staking and this preference of ETH or stETH or whatever staked version of ETH as like a preferred form of collateral. There's an enormous amount of nuance in this debate. I would just I'm going to link it in the show notes here. It's like an hour and a half, but I would recommend listening to this. Also attending live permissionless in October. Another little plug there. But here, so I actually there was I'll link it here, but I actually tweeted about this because I was also interested that the minimum viable issuance debate. There are a lot of implications for ETH, the protocol, but there are a lot of implications for the application ecosystem that's built around it. And one bit of pushback that I want to get your sort of last thoughts here on is that, hey, if there are applications which are built that only can exist with these sort of negative incentives of this unnecessary amount of yield that's being directed to proposers, then these applications shouldn't exist at all. And it's not the job of Ethereum, the protocol, to subsidize these applications that don't necessarily have great economics. And so I would just be curious, like,
I do not have any example of that in the ecosystem. Because if you remove STETH, Aave will still be here. MakerDAO will still be here, because we were here before the whole LST. We are preceding the existence of LST. LUSD will still be here, because you cannot use STETH as collateral. It's only pure ETH. Uniswap will still be here. It's going to be a bit harder and less profitable for ET now, but they will still be here. So that's not an argument. It's just that you create a more shitty economy on chain. You do not destroy this application.
Yeah, I mean, I'm also of there's a little bit of a funny, this is just musing out loud here. This was a long debate on the Blockworks Slack, but it is sort of funny where it's the opposite dynamic of something like the Federal Reserve, actually, where, you decrease interest rates or the amount of yield that's getting paid out to, holders of the risk-free asset. And that actually is a stimulus, right? And it's kind of the opposite in crypto. It's the more issuance that the protocol pays out, the better it is for some of the underlying, businesses. And maybe that's just a reflection that we don't really have like a traditional equity bucket in crypto yet. And so a lot of what actually benefits from additional yield would be like money markets businesses or banks or something like that in the real world. Like banks benefit from a steeper yield curve, and a lot of the apps that we have in crypto, like Aave, I would classify as kind of like a lower level. It's an application, of course, but it's like very bedrock in terms of how finance works. So anyway, and like Steve looks a little bit like a money market to me. But anyway, moving on here, I got two more questions for you, and I want to ask you about when Solana. So I've seen you in the past. Someone shared a screenshot of like even as recently as 2023. When people talked about, hey, is Aave ever going to move on to Solana? I was like, there's not a lot of users there, and the TVL is pretty low, and it doesn't really look that attractive. But recently I've been seeing you tweeting a little bit more about aggressively teasing a launch on Solana. So are there plans for that? And what changed in between 2023 and today that makes it look like a more attractive market?
Well, the first thing I want to say is that it's my job to be a profit maximalist for the DAO. So
Right.
I will, I hard and I will aggressively pursue new profit venues for the Aave DAO. That because
Mhm.
I'm paid for that, and that's what I do. And I'm a money maker for the DAO, and my company is designed to do that for the Aave DAO. So if a protocol and it's really important when you try to make money to not treat networks like religion, because you can say that your favorite soccer team is the best in the world and you will follow them no matter what, if they win or if they lose or if they get kicked out of the main league. But if you are trying to build a protocol and make it as profitable as possible for the benefit of the DAO governing it, you need to be flexible. So my vision of Solana changed significantly in the early days, then during the FTX event, and then change again in the recent months because we are very, very data oriented at Aave. So if we believe that Solana uh, potential revenue outweigh the cost of translating the Aave code base into a new language and make the audits and maintain a new instance on this network. Because we think the revenue we can make out of that will outweigh the cost, we will go there overnight. In the sense that we will propose that to the DAO, and the DAO are very aligned in the fact that they want to increase their own profit, so they will vote for it. Right now, it's not the case. It was not, but it's more the case where we are closer to that being the case than 6 months ago, and much more closer than 1 year ago. So we are actively monitoring this network because we believe the current growth they are experiencing is here to stay. We believe the DeFi ecosystem on Solana is weak in terms of quality of code and quality of teams. So it's not something that we think going to be particularly challenging to take the leadership position on this network. And we also believe that the LPs are not mature enough on the chain, and we can import our own ecosystem of LPs within this ecosystem, just like we did with Lido. So we grew Lido to 300 million in 3 days. That's 1/3 of the whole TVL of the Solana. And we did that in 3 days. And we did that without losing a single dollar in the other Aave market because it's all new liquidity that we bring from our network of LPs. So we can do that overnight on Solana as well. And we are very confident about that. And we have the weight and the economy to sustain a kickstart and liquidity mining program that is not paid in shitcoin, in governance shitcoin, but in hard stone cash, which is the Sol asset and the Go stablecoin. So that will make Aave significantly different than any alternative. And what we bring is the Aave quality as well, and the Aave brand within the ecosystem. So right now, if you ask the question today, I would say it's not economy viable to do it today, but it's better than 6 months ago, much better than 1 year ago. And ask me again in 6 months, and maybe you will find a proposal in the governance forum, because as soon as we believe it's a good deal to do it, we will do it.
Cool. All right. Well, we'll have to have you on again in 6 months, and we'll check back in on that. Last question for you, Marc, is there was some news over the last couple of days about WBTC, so Wrap Bitcoin, and a change in ownership there. So that came from Wrap Bitcoin was a BitGo product, and they announced that there was going to be they had sold a majority interest of that to BIT Global, which is associated with Justin Sun. And so this was a proposal that Monet Supply wrote in the MakerDAO forum, where he's proposing some changes and risk mitigation. So this is dated August 10th. And so he cites some of the there was a previous situation where there was a change in control for TUSD, the stablecoin, which was written about in the Maker forum. Since TUSD was placed in Justin Sun's control, it's seen market deterioration in operational processes and transparency, including the resignation of the previous management team, suspension of real-time proof of reserves, and several significant depegs caused by interruptions in redemption service. And so there's a whole bunch of stuff here, but basically the recommended action is, for the core vaults to decrease, 1.25 billion here of Wrap BTC as collateral. And then when it comes to Sparkland, disable borrowing and reduce Wrap Bitcoin LTV from 74% to 0. So basically you're essentially delisting it, right? Or not enabling it as a form of collateral. I think it backs something like 10% of outstanding DAI. Now, just to be fair, Mike Belshi, wrote a response here, which I'm listing on screen. It's too long to read out loud, but it basically like, hey, I feel like this is a reaction to the Justin Sun name. We were also concerned that some people would react like this, but I just want to say that I would look into BitGo is still co-signing all transactions, and a lot of the custody hasn't really changed in terms of the setup. So basically saying that there's not much risk. And I would question, I know Wrap Bitcoin is on Aave as well. And so do you share some of the same concerns that Monet Supply has? Are there any plans to sort of delist Wrap Bitcoin, as a form of collateral from Aave, or what are your thoughts on this entire situation?
The first thing I want to say is Aave decentralized. So if I were able to do something on myself and overnight, it would not be a DAO. So, and especially on Aave, there's currently 8 companies that are employed by the DAO to do specific scope and focus to add value to the DAO ecosystem and the protocol. 2 of them are specialized in risk. That's Llama Risk and Chaos Lab. And it's their job to provide feedback on these kind of assets. So both of them react very fast. Like 2 days ago, when we learned about this whole thing, and are preparing. They will probably be published today, later today or tomorrow on the forum, their vision of what is happening on the WBTC ecosystem. The second thing I want to say is there's a lot of legit users using WBTC because it was the most liquid, and it still is the most liquid and the most trustable with the Bitcoin name custodian with this asset to go from the BTC ecosystem to the EVM ecosystem. So it's very important for us at the ACI to not hurt legit users. So if we echo the concerns and the risk service provider of the DAO share those concerns, and I think that's the current situation right now, it's very important to provide our user with an alternative to allow them to migrate their position with another kind of collateral to make their position and the situation with the less friction as possible, to hurt them less, because they are at no fault on what is happening right now. They open their position in Aave believing on a specific ecosystem and a specific custody for the WBTC asset. And what we are learning is that in the next few weeks, there's a potential that the fundamental of this asset will change, and not for the better. So it's important to provide an alternative to make sure this asset that want to use Bitcoin as collateral can still use Bitcoin as collateral within the Aave ecosystem. And the good thing is that we already implemented the alternative within the Aave ecosystem. So Avalanche and the Avalanche Foundation created BBTC, which is an alternative that they create with their own bridge. And we actually delisted WBTC on Avalanche altogether more than a year ago in favor of this alternative, because we believed that it was a more decentralized way to bring exposure to the Bitcoin ecosystem within the Aave protocol. There's alternative to WBTC, but still it's up to governance and the service provider to provide feedback first. What we're going to do at the ACI is to make sure the Aave user stay safe. They have alternatives that are important for them if they want to migrate position, and there's a need to migrate position to another kind of collateral, and to impact the Aave protocol and the Aave DAO the less. Because at the end of the day, it's always a balance between risk and the user experience.
Yeah. Well, Marc, unfortunately, that is all the time we have. You've been super generous. We've gone a little bit over here.
Last thing I want to say about this is that BitGo announced that there's going to be no movement for the past 2 months. So that's why we can afford to take it slow at the Aave DAO and make sure, because it's a significant chance that billions of dollars of WBTC liquidity and billions of dollars of position using WBTC as collateral. So that's not something that we want to change overnight. That's something that we seriously consider. It's very important for us because we do care about our users, but we don't have to give an answer overnight.
Yeah. And actually I saw Where Meow, the founder of Jupiter. I didn't realize he was actually heavily involved in Wrap Bitcoin as a product, but there was some back and forth between him and Mike Belshi and Justin Sun, actually. So maybe we'll get some clarity in terms of how that's actually going to work on the back end. But Marc, you've been super generous with your time. We've gone a little bit over here. If folks want to find out more about you or follow the work that you do, or maybe delegate to you, as in your propensity or your, current seat at the ACI, like what's the best way for them to follow you?
They can follow on Twitter. I usually say stuff, and sometimes it's a bit funny to follow. My handle is Lemiskate. It's on screen right now, and you can find me there. Otherwise, you will see my name on the Aave DAO forum because that's where I spend most of my time. And feel free to contact. My DMs are open, and I love to stay in touch with the community. So if you have any question about the Aave ecosystem, there's a Aave Discord. I'm there every day, or my DMs are open.
Excellent. All right, Marc, this was a ton of fun. Thanks very much again for coming on.
Thank you for your time.
Hey everyone, hope you all enjoyed today's episode. Want to give a final shout out to Namada. Again, a team that is near and dear to my heart. They are building the Shielded Asset Hub, which is protecting the future multi-chain. Talked a little bit about how that works in the mid-roll, but for now, what I would highly recommend that you do is go check them out. They're in their mainnet launch phase. You can follow along with everything at namada.net. You can start rewarding yourself by shielding your actions and strengthening data privacy for all across the multi-chain. So thanks again, Namada, for all the great work that you're doing.